This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, August 12, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is staring down a wall of silence. SPY sits at 770.56, essentially flat at the open, but don't let the quiet fool you. Underneath that calm surface, the market is splitting in half. Large caps are bleeding, tech is lagging, but somewhere in the small cap realm, money is quietly hunting for yield. It's a bifurcated landscape, and right now, the data is screaming defensive rotation louder than it's whispering growth. Looking ahead to the week, the macro calendar is packed with inflation and employment data that will test this delicate balance. First up is Thursday, August 14th, when we get consumer price index readings and producer price index data. These prints will be crucial in determining if the sticky inflation narrative holding back rate-sensitive sectors like real estate is justified. Following that, also on the 14th, retail sales figures will tell us if consumer spending is still supporting that 1.5% GDP growth, or if the cracks are widening. And finally, early Friday brings initial jobless claims, offering a quick pulse check on whether that minus 23K payroll decline was a blip or the start of a broader labor cooling. Apex, for the top event, what's the specific lens?
With CPI and PPI hitting on the 14th, the focus isn't just on the headline number, but the core components. Given that core PCE is already at 3.29%, any upside surprise will reinforce the hawkish pressure, keeping the VIX suppressed at 15.46, while simultaneously crushing the upside for rate-sensitive assets like the real estate sector.
Let's look at where we stand as of 9:20 ET. Broadly, the majors are down slightly. SPY is at 770.56, down 0.32%. Triple Q is at 718.45, off 0.34%, and Diamonds is at 537.28, also off 0.32%. But the real story is the divergence. IWM is green, sitting at 300.99, up 0.34%. Sector-wise, energy is leading with the energy sector at 60.93, up 1.25%, and utilities are strong with the utilities sector at 43.63, up 1.16%. Meanwhile, tech is struggling with the technology sector at 186.9, down just 0.12%, and real estate is getting hammered with the real estate sector at 44.8, down 0.72%. Pulse, walk me through this divergence. Why is the VIX so calm while the indices are splitting apart? It's a textbook complacency trap. The VIX is stuck at 15.46, which is well below the recent 5-day high of 18.43. That tells me nobody is panicking yet. They're just rearranging deck chairs. We see capital flowing out of high beta, rate-sensitive plays like real estate. Look at the real estate sector's minus 2.41% weekly loss, and into inflation hedges like energy. The minus 0.32% drop in SPY isn't a crash, it's a prune. The market is shedding valuation-heavy tech to buy tangible assets. The sentiment isn't fearful. It's indifferent to large caps but greedy for yield.
And that indifference is visible in the charts. SPY is trapped in a compression zone. Look at the 10-day range, 729.1 to 776.85. SPY is at 770.56. It's barely $6 below that 776.85 resistance. For 2 days it hasn't been able to close above 774. That's exhaustion. There's no volume behind this push. Meanwhile, look at Triple Q. It's pulled back from its 10-day high of 728.54 down to 718.45. That's a $10 gap. The first line of defense is 715.5. If that breaks, we aren't talking about a prune, we're talking about a structural breakdown in tech leadership.
Speaking of tech leadership, let's look at the movers. We have some significant gap-ups in AI infrastructure names. Supermicrocomputer, SMCI, is up 9.7% to 34.67. Marvell Technology, MRVL, is up 4.7% to 222.29. Conversely, we see massive weakness in COR, down 17%. Kava is also seeing massive momentum, up 18.8% to 72.25 on growth driver headlines. CIPHER, how are institutions positioning around these AI movers versus the broader tech lag?
It's a very selective bid. In the technology sector, which is down 0.12% overall, the drag comes from legacy giants. NVDA is barely up 0.35% and MSFT is up just 0.21%. But SMCI and MRVL are showing extreme fundamental conviction. The flow data on MRVL is tied to new product announcements in AI memory, which is a tangible, revenue-generating catalyst, not just hype. SMCI 9.7% gap up is news-driven, likely amplified by public commentary, but the key here is that this liquidity is not spreading to the broader triple Q. It's trapped in these specific nodes. We're seeing a decoupling of AI narrative from AI reality. The big guys are coasting, the infrastructure builders are sprinting.
I'd caution against calling that conviction. Look at the macro backdrop. The 10-year, 2-year yield curve is flat at plus 0.48 pp. A flat curve is a historical precursor to slowdowns. These AI names are valuations stretched thin on future growth expectations. If that yield curve steepens, or if the CPI print on the 14th comes in hot, that conviction evaporates fast. SMCI is up nearly 10% overnight. That's a liquidity event waiting to reverse. The VIX is low because traders haven't realized that the cost of carry is about to eat these margins alive.
Let's zoom in on the outlier. While SPY and triple Q are red, the Russell 2000 is green. IWM is at 300.99, up 0.34%. Grid, technically, does this break the trend?
It's approaching a breakout, but it's fragile. IWM is at 300.99. Yesterday's high was 301.99. The 10-day high is 303.6, so to call this a breakout we need a clean close above 302.3. Right now it's hovering right at the edge. The 10-day range is 287.83 to 303.6. Being at 300.99 means it's in the upper quartile. But remember, there's no volume confirmation here. Pre-market volume is dominated by microcap anomalies like LSPR and FNGA, not broad index participation. This looks like a squeeze, not a rally.
I agree it's fragile, but the reason is interesting. This isn't just a squeeze, it's a rotation. Capital is fleeing the mega-cap tech exposure. Remember, the technology sector is down 0.12% and moving into domestic-focused entities. The IWM strength is a vote of confidence in domestic manufacturing and services, which are less exposed to the global currency headwinds affecting the S&P 500 components. The VIX is low because this rotation is orderly. It's not a panic sale, it's a rebalancing.
That's a dangerous interpretation. Look at the fundamentals. Non-farm payrolls declined by 23K. GDP is stagnant at 1.5%. Small caps are the canaries in the coal mine for credit stress. A flat yield curve destroys small cap financing costs. This IWM rally is a desperation yield hunt. When the labor market data cools further, or if that CPI print hits hard, these small caps will be the first to get liquidated because they have the weakest balance sheets. The orderly rotation Pulse describes is actually a slow leak of liquidity from the broader market into a few safe havens, leaving the periphery exposed.
So, Grid, if that 302.3 level doesn't hold, where do we look?
We look at the downside risk. If IWM fails to clear 302.3, expect a rapid mean reversion back toward the lower end of that range. Simultaneously, watch SPY's support at 769.2. We've seen 2 consecutive closes below 774. If SPY loses 769.2, the consolidation turns into a breakdown. There is simply not enough institutional volume to defend 776.85 right now.
On the flip side, let's talk about the leader. The energy sector is up 1.25% today, sitting at 60.93. Over the last week, it's up 4.12%. CIPHER, what's driving this inflow?
It's a direct response to the stagflation-light environment. With CPI at 3.46% and core PCE at 3.29%, investors are pricing in persistent inflation. Energy is a tangible asset hedge. Unlike tech, which relies on discounted future cash flows that get crushed by higher discount rates. Remember, the Fed funds rate is 3.63% and sticky. Energy companies are generating cash now. Plus, with the trade-weighted dollar index at 119.6, you might think a strong dollar hurts oil, but the rotational flow is stronger than the currency effect. Money is moving out of real estate, down 2.41% weekly, and into energy. It's a substitution effect within the S&P 500.
And sentiment on the energy sector is incredibly bullish. The weekly gain of 4.12% suggests institutional accumulation. Contrast that with real estate, which is showing fear with that double-digit percentage loss. The market is clearly voting with its wallet. The VIX staying at 15.46 confirms that this isn't a panic-induced move into energy. It's a strategic allocation shift. Traders are using the energy sector as a portfolio insurance policy against the upcoming CPI print.
But consider the risk. The 10-year yield is at 4.72%. If yields stay sticky at that level, even energy faces pressure eventually. More importantly, this rotation is narrowing market breadth. If the energy sector is carrying the S&P 500's green status while QQQ and the technology sector are red, that's a sign of weakness, not strength. A healthy bull market lifts all boats. This is a one-legged rally. If energy stumbles, the entire index structure collapses because there's no other engine running. The calm VIX is hiding the fact that we are dangerously dependent on one sector.
So if energy stalls, the index drops. What about the tech pullback? QQQ is at 718.45. Grid is 715.5, a hard floor.
715.5 is yesterday's low and the immediate support. Below that, you open up a gap to 715 and potentially deeper into the 700s. The 10-day high was 728.54. We are almost 14% off that high in absolute terms. No, wait, checking the math. It's about a $10 gap. The distance from 728.54 to 718.45 is significant. If QQQ breaks 715.5, the technical damage is done. We'd be looking at a retest of the 20-day moving average, which isn't tracked in my 10-day range, but psychologically, that's where the next buyer steps in. Until 715.5 holds, the path of least resistance is sideways to lower.
Finally, let's touch on the specific AI names. SMCI is up 9.7% to 34.67. MRVL is up 4.7% to 222.29. CIPHER, you mentioned earlier that this is selective. How far does it extend?
It extends to the hardware layer. SMCI and MRVL are benefiting from actual CAPEX cycles in AI infrastructure. NVDA is the giant, but it's already priced for perfection. These mid-caps are catching the overflow. However, look at the float. SMCI is a high-velocity stock. A 9.7% gap up is a magnet for profit-taking. The new score is high, meaning retail attention is peaked. Institutional flow is cautious. They aren't chasing the gap. They are watching the open to see if the momentum sticks or if it fades into the 769.2 SPY support level.
Retail sentiment on SMCI is likely overheated. A 9.7% gap is rarely maintained without a cool-down period. The put/call ratio on these names is likely skewed long, meaning gamma exposure is heavy. If the broader market dips, which Grid warned about with the 715.5 break, those long gammas will have to unwind, exacerbating the drop. It's a contagion risk. If SMCI reverses, it drags the QQQ down faster, pulling 715.5 into question.
And don't forget the regulatory risk. With CPI at 3.46%, the Fed's hawkish stance limits rate cuts. Higher rates for longer hurt the valuation models of these high-growth tech names. SMCI jump is a bubble. If the CPI print on the 14th shows inflation is stickier than expected, those infrastructure narratives get slapped down instantly. The VIX is low because people think the soft landing is secure. But if the labor market, 23K job loss, and inflation collide, that 9.7% gain becomes a trap.
To tie this together, Grid flagged the 715.5 support failure as a key technical risk for QQQ. CIPHER highlighted that the liquidity in SMCI and MRVL is narrow and prone to reversal. SPECTER correctly identified that the low VIX is masking a structural fragility driven by a flat yield curve. The consensus is that the market is rotating defensively. Energy is holding the line, but tech is unraveling. Unless SPY can reclaim 774 with volume, the weight of that tech depreciation will pull the whole index down.
So here is the bottom line for your watch list. 1. Watch the IWM breakout above 302.3. If it fails, small caps revert and liquidity dries up. 2. Monitor QQQ's 715.5 support. A break below accelerates the tech sell-off, dragging SPY towards 769.2. 3. Keep an eye on the CPI data on August 14th. That print validates or invalidates the current defensive rotation into energy. Tomorrow, we'll see if the soft landing narrative survives the jobs report. Stay sharp. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.